Hello everyone, and you're very welcome to today's webinar. So just a reminder that this webinar is being recorded and all attendees will receive an email later today with a link to the recording of the webinar and a copy of the presentation slides. So it's no problem if you do need to leave at any stage. You can also download the handouts right now if you wish on the Handouts tab on your control panel. So first off, I'd like to introduce Bright. And Bright is home to multi-award winning payroll, accounting, practice management, and tax software. So I'm just going to give you all a very short introduction to each of the Bright products. BrightPay is payroll software that makes managing your payroll quick and easy, and it's currently desktop-based. Accountancy Manager is a cloud-based practice management software designed to lighten your workload by automating your admin. Surf is a cloud accounts production software with a bookkeeping module, Surf Accounts. And BrightPay has direct API integration with Surf Accounts, allowing both the payroll software and accounting software system to directly communicate with each other. And lastly then, BTC Software is a tax software expert with accounts production, corporation tax and self-assessment tax return modules. And just to note that this is currently only available in the UK. I want to introduce ourselves. So my name is Holly McHugh and I'm a marketing team lead here at Bright. And I'm joined by Elaine Carroll, who is the content marketing specialist here at Bright. So next, I just want to have a look at the agenda for today's webinar. So in the first part of today's webinar, we are going to look at what is auto-enrolment and what do we know about the scheme so far. We'll then briefly go through the role of auto-enrolment in the UK. Next, we will go into detail on the effect auto-enrolment will have on your clients. And in this, we will discuss how you can communicate the changes to your clients, how you can best prepare your practice, and how auto-enrolment can open up a new revenue stream for your practice. At the end of the webinar, we will have a questions and answer session where we will do our best to answer any questions that you may have. Paul Byrne, the former CEO of Bright, and Mark McDonough, who is our product manager, will be joining us today for the questions and answer session. So I can now pass you over to Elaine to begin today's webinar.
Thanks, Holly, and hello, everyone. Automatic enrolment in Ireland is a subject which has been in discussion for over 25 years. However, after being delayed a number of times in recent years, it is now due to be set up this year. Employee enrolments into the scheme are planned to take place in 2024, with contribution amounts to increase on a phased basis over the next 10 years. So we're just going to do a quick poll now just to see how much of our audience has clients who currently offer private pension schemes to their employees. So the question is, approximately how many of your clients' employees are currently enrolled into private pension schemes? So as you can see on your screen there, you can choose between the majority of employees, more than half, less than half, or not that many or none at all. So I'll just give you a minute now to vote and then we'll share the results. So the results are in and 5% of you said the majority of employees, 6% said more than half, 21% said less than half, and a big 68% said not many or none at all. So some interesting results there. So thanks everyone for taking part in that poll with us. So just moving on then with the webinar. Under the automatic enrolment system, workers will be automatically enrolled into a workplace pension scheme, but they will have the option to opt out or suspend participation after 6 months of enrolment. However, looking at international experience of similar systems, for example in the UK, once enrolled, workers tend to remain in the scheme. Employees who do opt out after 6 months of being enrolled need to be re-enrolled after 2 years. All employees not already in an occupational pension scheme, aged between 23 and 60, and earning over €20,000 across all of their employments will need to be automatically enrolled into a workplace pension scheme. The scheme is expected to impact around 750,000 workers. All employees outside of these criteria may decide to opt into a scheme. Both employer and employee contributions will start at 1.5% in 2024. Contribution rates will then increase by an additional 1.5% every 3 years until they eventually reach 6% by 2034. To encourage workers to participate, those who choose to remain in the system will have their pension savings matched on a one-for-one basis by the employer. The state will also provide a top-up of €1 for every €3 saved by the worker. This means that for every €3 saved by the employee, a further €4 will be invested by the employer and the state combined. Employees will have a range of 4 retirement saving funds to choose from, each with varying risk-return profiles. There will also be a default fund based on what is known as a lifestyle or life cycle investment profile. Those who do not express a preference for any fund will be enrolled into the default fund. For people moving between jobs, they will not need to change pension schemes or join a new scheme. They will remain members of the auto-enrolment scheme on a pot follows the member basis. For those with multiple employments, their pension savings will be consolidated into one pension pot. The auto-enrolment system will be managed by a Central Processing Authority or CPA, which will be responsible for the overall administration of the system. The CPA will carry out a number of functions, including administering the funds when members reach retirement age and providing a pension portal for employees. With the portal, participants will have visibility of their pension pot, be able to select the scheme they wish to use, and see their savings pot grow over time. January 2024 is fast approaching, and getting the scheme up and running by early 2024 will be challenging. As well as a lead-in time of at least 18 months to properly develop, test, and deploy a fully operational system, businesses will need time and guidance to get ready for this change. At BrightPay, auto-enrolment is something that we already have programmed into the UK version of our software. Thanks to this experience, we already have the knowledge of how auto-enrolment in the software should work. Our aim, as is with BrightPay UK, will be to make the auto-enrolment process as simple for the user as possible. A similar scheme was introduced in the UK and is widely considered to have been successful. It was introduced in 2012 and in the 10 years that followed, achieved over 114 billion in savings. While the Irish government are looking to introduce a similar scheme, they will also look to learn lessons from the mistakes that the UK made in implementing auto-enrolment. So I'll now pass you back over to Holly to talk about how auto-enrolment will affect your clients.
Brilliant, thanks Elaine. So how will auto-enrolment affect your clients? Auto-enrolment will have an effect on revenue and add more paperwork to their plate. If your clients don't already have a private pension scheme in place, they will have to match each employee's pension contribution. Depending on how many employees they have and their salaries, could end up costing your clients quite a bit. It will be the job of the CPA to determine employee eligibility and instruct the employer accordingly through the AEPN, which stands for the Auto-Enrolment Payroll Notification. There are also a number of ongoing responsibilities that clients must be made aware of. This includes handling opt-outs, opt-ins, and joining requests, making deductions and contributions, monitoring employees each pay period, and more. Currently, it is intended that employees with earnings over €20,000 across all employments will be eligible. Employees should also be informed of how auto-enrolment will affect them in advance, so they're aware of the changes on their payslips before they happen. It also lets employees ask any questions that they have early on. Clients should ensure that staff records, including their dates of birth, salaries, and contact details, are correct and up to date. Employee records must be kept, including earnings, contributions and deductions, and other relevant information regarding the auto-enrolment scheme. And all records must be kept in such a manner that they are legible or they can be provided to the regulator. However, many clients are confused about auto-enrolment at the moment, so they'll need help understanding their responsibilities and what the implications are when these duties aren't carried out. So this is where you come in. It's imperative to communicate the changes auto-enrolment will bring to your clients in a way that they understand. Focus on the client's perspective and how it will impact their businesses. Let them know what they need to do in advance and some ways that they can best prepare for the changes sooner rather than later. Now is the time to get ahead of the curve and inform your clients early. Take this time to really become a knowledge base, which can be a necessary asset for your clients. This helps to build trust and puts you in a better position when offering auto-enrolment services next year. So as your service offering is expanding, your fee structure should reflect that. Early and clear communication is key to successfully increasing price. Communicate to clients and explain to them why your rates are increasing. Focus on the client benefits and justify the reasoning behind it. Outline the additional work and expertise required. You could meet with the client and outline exactly what is involved in auto-enrolment, and then let them choose how much work and responsibility that they want to take on. Clarify the new pricing structure, outline who is responsible for what, and specify the date that it will come into effect. Time is money, as the saying goes, so by outsourcing to a professional, your clients can avoid investing huge amounts of time researching how to comply with auto-enrolment. It frees up their energies and enables them to focus on the core areas of running their business. Without your help, clients might go down a very costly path. The implementation of auto-enrolment could also be very time-consuming if they don't have the technology or the software in place to automate a lot of the manual admin tasks. So, especially for small and micro employers, their time is extremely precious. Time away from their business is money. With you at their side, clients can avoid costly mistakes and save time in auto-enrolment that otherwise would have taken up a lot of their time out of their normal working week. Outsourcing will provide a level of continuity to the company while reducing the risk of possible non-compliance. So by offering a complete end-to-end solution, bureaus and accountants in practice can generate income and enhance clients' relationships. So where do you start? So the vast majority of clients will have no expertise in auto-enrolment and won't have the knowledge or expertise to make well-informed decisions. One of the best things that you can do now is to offer a free auto-enrolment consultation with clients. So from what you've learned in this webinar, you have all of the essential information that you need to get started. This allows you to explain the various administrative aspects of auto-enrolment. The main advantages of this consultation that you can have is the client will begin to understand how much is involved in auto-enrolment, and the client will be much more receptive to your fee quotation. The faster you approach each client through automatic enrolment, the more you will increase productivity and revenue. It's also important to take a look at your payroll software provider. So just be aware of any hidden costs that they may charge. As with software providers, you may have to pay additional costs for auto-enrolment functionality, for support, and if you have any additional employees. Here at BrightPay, as Elaine mentioned, we have been down this road before. So when auto-enrolment was rolled out in the UK a decade ago, our auto-enrolment functionality was free and no additional cost to the user. So we're incredibly familiar with it and not planning to charge for it when it's rolled out in Ireland. So to keep up with the latest announcements on automatic enrolment coming to Ireland, you can visit the website gov.ie. So we'll move on now, and I know we touched on it at the beginning, but we wanted to give you a quick reminder of who we are. So Bright is home to multi-award winning payroll, accounting, practice management, and tax software. As well as BrightPay, other products in the Bright family include Accountancy Manager, Surf Accounts Production, and BTC software. So I'm just going to put a poll up on the screen now so you can register your interest in any of the Bright products, and we're just going to have a quick look through the questions and answers before we get started. Now, I know it didn't seem like a lot of time through that content, but that is literally everything that we know so far, and I do think it's quite content heavy, and you will have a chance to have a look at the slides and the recording later on. Great, a big thanks to everyone who registered their interest there in the poll. So it's now time for the questions and answers. So if you do have any questions, please feel free to type them into the questions bar, and we will try to get through as many questions as possible. So we're joined by Paul Byrne, who is the founder of Bright, and Mark McDonough, who is our product manager, to answer some of your questions. So welcome, Paul and Mark, and I'll pass it over to you guys now.
Good morning, Holly. Thanks for the introduction. We have a few questions in here I can see, so I'll just take them in the order I suppose that they're coming in. The first one here I see is, if someone has multiple jobs, is it mandatory to have the pension on all employments? I think what's going to happen is that basically the information on employees' earnings are being collected at present through the PSRs, which are submitted every pay period. And revenue or the CPA or whatever will gather that information and see whether the total from all those jobs is in excess of the lower band, 20,000. And if so, then all the employments will get an instruction to actually deduct the auto enrolment and make the contribution to it as well. Would that be your understanding, Mark?
Yeah, Paul. Yeah, that's correct. Yeah, it's all based on the employer will effectively have no decisions to make on this. This is effectively an employee decision, and they will communicate directly with the Central Processing Authority. And based on the communication between the employee and the Central Processing Authority, an instruction will be issued directly to the employer as to what the value of the deductions that will be required to be made, and then obviously legally obliged for the employer to make those deductions and submit the payments and the data back to the Central Processing Authority.
Yeah, and it's our understanding at present that it'll be something similar to the instruction that, say, an employer receives on the RPN, which is basically, I think it'll basically just say whether you deduct or not deduct. Or whether the automatic enrolment applies to the employee or not. And as you say, it's not up to the employer. It's totally between the employee and the Central Processing Authority as to whether they've opted out. And again, as the webinar covered, the opt-out can only happen after 6 months of the actual enrolment having been instigated in the first place.
Yeah, because again, there's a number of questions coming in there about how will an employer know if an employee is earning over 20,000? That's irrelevant from an employer perspective, because obviously the employer will never know if the employee is earning monies elsewhere and what the thresholds are. So the employer is going to be totally dependent on receiving the instruction directly from the Central Processing Authority, who will have access to all that information. So an employee, as their total earnings across all employments will be visible to the Central Processing Authority, and then they will then inform relevant employers of the deduction through what they're calling at the moment. We have the RPN, the Revenue Payroll Notification, used obviously that we're all familiar with now since 2019 for tax USC instructions. They will also have what they're terming at the moment an AEPN, which is obviously an auto-enrollment payroll notification. So that's the intention at the moment. How it's actually going to be implemented, we still don't know. The legislation is still in pre-scrutiny in the Oireachtas. It still hasn't actually reached the floor of the Dáil. So the legislation has yet still to be passed. So things could change as it moves through the Oireachtas.
Yeah, and just I suppose as an aside, as developers, we're hoping, I guess, that the actual instruction on whether to apply auto-enrollment or not is actually contained within the RPN, which will save a bit of time having to develop the additional functionality for the other instruction coming from the CPA. But yeah, that's all to be figured out over the next few months, hopefully. And I guess that another aside, it's good to mention that it's totally simplified, I guess, in terms of, well, what the suggestion is at the moment in terms of how the system will operate. It's going to be much simpler than it has been in the UK. I think they've learned a lot of lessons from the UK experience. And again, just coming back to the situation as developers in the UK, we had to develop code for all the different pension schemes, the different pension companies that operate over there in terms of transmitting the information in relation to contributions and so forth. Whereas in Ireland, it's going to be just with the CPA that the transmission occurs. So it'll be one file format that we'll have to worry about. So that's actually a good thing on our part. And the other thing is in the UK, you had to send all these employee communications from the payroll as to, what it meant that they were enrolled or opted out or whatever. Whereas our understanding is that any of the communications are just going to be from the CPA in the Irish scenario. So that's a good thing. Just go on to the next questions. And I know, actually, any questions striking you, Mark, that you wanted, because I know there's loads coming in here, so it's trying to prioritize them.
Yeah, there's a couple of questions about what is the Central Processing Authority. The Central Processing Authority will be, again, I can't remember which department it's actually under. It's a mixture of the Department of Social Protection and our Justice, believe it or not. But essentially, they are the authority that's going to be tasked with the job of the management, implementation, and control of the pension funds and auto enrolment in general. So that's what the CPA is. It becomes the focal point of all auto enrolment pension schemes. In terms of the percentages, it is on gross pay. There's a couple of questions here as to what the 1.5% is on. It's on gross pay. Now, again, it's not totally clear and has yet to be defined as to what gross pay actually is. So that will be part of the implementation process. We will need to know whether it is purely on basic pay, or does overtime come into it, or commission, or all sorts of other gross pay elements, whether they will form part of that. That's still not totally clear. That will come out in the wash, and once the legislation is passed, we'll be in a better position to be able to answer that. Does it, in terms of, is it tax allowable? Is there grants available to the employer? The answer is no. It will be an employer cost.
But they get tax relief. They get tax relief or whatever on it.
Correct, absolutely. Which is good. But the employer contributions will increase over the 10-year period. I think it's to a maximum of 6%, if I remember correctly. So it'll take time to bed down. My own guess is that 1 January is for 2024 for implementation is a very, very tight time frame. From a standing start to actually get everything up and running for the 1st of January 2024, let alone payroll software changes that will have to be made. And I know there's a couple of questions in there. Has the updates been made to the software as yet? The answer is no, because we don't know what the changes are, other than we know that auto enrollment is coming, and that we will need to be able to handle it. But it's going to be a challenge.
Sorry, just one interesting thing there when you mentioned about CPA and what it is. One of the interesting things I saw about the CPA was that the actual pension companies that the CPA deal with, which would be up to, I think it's 4 pension companies, they will not have any knowledge of who the actual employees are that are contributing. it'll just be the CPA that knows that. So it's actually interesting from that point of view, and that the pension companies won't actually have, you know, an opportunity, I guess, to try and upsell or cross-sell to those employees, which is, you know, something that life companies would have done in the past. So it's actually very much, I suppose, linked to GDPR and stuff like that. But that was, it's interesting from the point of view that the contract is really between the employee and CPA. And as you said before, the employer doesn't have any decisions in this process whatsoever, really. Just have to make sure, I suppose, just have to make sure that their software can do the necessary. And one of the questions in there is, will the SOAR's payroll manager have the update? And yes, of course it will. Because I mean, I suppose auto enrollment is going to affect our customers mainly, because though the companies that aren't affected by this are the public service who already have pension schemes in place, or large companies that have, you know, occupational pension schemes, whereas, you know, most of our employers are small to medium or micro employers, and a lot of them, as in the survey showed earlier on, won't actually have a pension scheme in place. So they will all come under auto enrollment, the legislation here. I think one of the questions as well is if somebody already has a private pension scheme in place, will auto enrollment be necessary? And I think if it's an approved occupational pension scheme, then they won't need to be auto enrolled. But it was just the employee, the employer facilitating the employee making deductions through the payroll, where the employer isn't contributing whatsoever. I think they will actually come in under the AE legislation in that case.
Yeah, Paul, that would be my understanding too. If the employer is not making any sort of pension contribution to an employee's fund, then the employer is now legally obliged, or will be legally obliged when auto enrollment comes in, to be making contributions. Now they could change their. They'd have two options really. Sorry, Paul. They could use auto enrollment, or they could change their own internal pension schemes and start making contributions.
Yeah, and it's probably a bit like the argument we had in statutory sick pay, where you know, the existing scheme is better or at least equal to the proposed scheme, well then that's fine. But you know, as the rates on auto enrollment go up, you know, and end up the 6%, and the government contributing 2%, it will be a case that a lot of, I suppose, the occupational pension schemes will struggle to maybe meet that high bar at that stage, and they'll probably have to apply the auto enrollment in that particular case, or as you say, actually amend their existing schemes to at least equal the auto enrollment scheme.
Yeah, the other thing, a couple of questions in here about, can employees start off giving 6%? In theory, yes. However, from an employer perspective, it will start. The employer will still only be legally obliged to pay 1.5%. However, through the CPA, the employee can elect to also make an additional voluntary contribution type payment, so an AVC, to the auto enrollment, and that can be done in two ways. It can be done through payroll. So again, an instruction will be supplied to the employer to deduct the relevant percentage, and the instruction from CPA will give two figures. It will give what the employee's percentage deduction is and what the employer's percentage is. So if there is, so the employer, sorry, let's try that again, Mark. So the employee will have the ability to have to make contributions over and above that will be legally deductible, i.e. the 1.5% initially.
Oh, that's interesting, because I actually thought it was just going to be a yes or no in terms of whether you deduct or not. But that, yeah, you'd have to allow for, you know, if the actual percentage deduction is going to be higher than the specified minimum.
Yeah, my understanding is that on the AE it will have an employer percentage and an employee percentage. The other thing just to be aware of, that it is on all earnings above 20,000, and that's across all emoluments. Sorry, across all employments. There is also an upper employer limit. Now again, of 80,000. Yeah, that has yet to be confirmed, but it's also one of these likely figures that will change over time, obviously, as due to inflation and things like that. the 80 grand will probably grow over time. So the upper earnings limit will change.
That's one of the things I was probably a little bit confused about on the 80,000. You're saying that's just the employer limit. The employee, is the employee still required to contribute over that amount? I wasn't too sure from looking through the guidance.
Again, my understanding is that the employees can continue to, because that's their decision in terms of whether they want to continue to contribute, but the employer's contribution at the moment ceases at 80,000. Again,
okay, well, that'll be kind of another instruction then on the RPN or the equivalent that will come with the software. Yeah, okay.
Correct. And again, it's not totally clear from the existing guidance as to whether that 80 grand is per employer or across all employments. My guess, looking at the guidance, is it's per employer.
I would have thought the other way.
Yeah, and
as I say, all these things have to be ironed out, but
yeah, because again, obviously, an individual employer is not going to have any visibility of what an employee is earning in other employments, obviously for GDPR and all that sort of stuff. So I'm not even sure how the CPA will be able to control that.
Yeah,
because it'll want to be real time in that sense. And the other small point to make is that when these deductions are being made, the current suggestion is that the CPA will want the payment of the employee and employer deductions to be paid over on or before payment day. So if you've got a weekly payroll and you're deducting, and as part of that payroll run, there are AE deductions being made from the employee, then both the employee and the employer equivalent payments will need to be paid over to the CPA at the end of that payroll period.
That's going to be very difficult, really, for a lot of employers.
It is. That's going to put obviously cash flow one, but also there will be. I mean, it seems a little bit rich to some extent, looking for payment that quickly, but that's what is being suggested at the moment. So again, payroll software will probably need to be able to handle essentially creating an additional payment as part of the SEPA file at the end of each payroll run to include the payments directly to the CPA.
Yeah. One other thing as well, let's see on the questions here, the 20,000 minimum to qualify in a way for the auto enrollment. If you're under that, you can actually you can opt in. I suppose it's a case that you notify the CPA that you do want to make contributions, and the employer will be obligated to obviously follow the instruction that comes from the CPA in that respect. The opt-out, you can opt out after 6 months. They specify month 7 and month 8 is the time frame or the window you have to opt out. And again, it'll be up to the employee to notify the CPA in that case. They're planning to have all this, I suppose, on smartphone apps, and you can log in to view how your pension is doing, and also to communicate your instructions as to which fund, or whether you want to opt out, whether you want to suspend. So it remains to be seen how good this system will be, but that's the plan at this stage anyway.
Yeah. In terms of the question here about would the deduction be sent to CPA or to revenue, at the moment it looks as if it will go to the CPA directly. Okay, that's the guidance, or that's the indication at the moment. It probably makes it may be easier if it actually became another tax head in inverted commas. That might work easier, might work more efficiently. But at the moment, the indications are that the payment of the deductions would be made directly to the CPA. The other question that has just a number of people have entered in there is, if an employee elects to pay more than the 1.5% initially, does the employer have to match? No. The employer only has to match what is legally obliged. So in the first 3 years, 1.5% for the employee, 1.5% for the employer. If the employee elects to put in an additional amount, say an additional 3%, so they're paying a total of 4.5%, the employer is still only obliged to pay 1.5%.
And I presume revenue will just contribute on the basis of the minimum as well in that case.
Yeah. Government are tied into the 1.5%, not to the ABC amounts.
One other question there, which is quite interesting: will the scheme apply to company directors? Like I know in the UK that directors don't have to go along with the scheme because it's assumed that they already have other sort of arrangements in place. So it'll be interesting. At the moment, there's no indication that directors are going to be excluded. But obviously, directors would have the option to opt out after the 6-month period anyway, if they are to be included.
There's a question here that says, does this mean that the employee earning over 100,000 that they are not able to enroll? No, an employee earning 6 figures is entitled to be part of the auto enrollment process. All it would mean is that the employer's contributions would cease at the 80 grand limit, but the employee can continue to contribute on all income.
What will happen with seasonal workers? Again, the employer doesn't really have to be concerned with keeping track, I guess, of employees' earnings. It's actually the central processing authority that will do that, and they will provide the employer with the instruction on whether to actually apply auto enrollment or not. Interestingly, if somebody basically qualifies for the scheme because their earnings in a particular pay period are over a certain figure, if in the following pay period their earnings are less, the instruction still applies to deduct the 1.5% on those earnings, because they've actually enrolled into the scheme because of one pay period in which their earnings actually exceeded the minimum. So again, it's a bit like in the UK, that once you're in, and unless you opt out. So if somebody has very low earnings after initially qualifying because of reasonable earnings, they will still need to have the auto enrollment deducted. But anyway, the instruction will be coming every pay period from the CEPA as to whether and what rates to apply.
Correct. And just following on from that, then does it apply to part-time employees? Absolutely. And does employees have to be employed for a certain period of time? That doesn't appear to be the case. Again, probably open to clarification at a later stage. But again, it will not be an employer decision as to when that employee commences auto enrollment deduction. It will be an instruction directly from the CPA. And there's also a question then for employees with multiple employments paid on an hourly basis, are they planning the payment by the employer being equal or being spread across employers, or on a pro rata basis? It will be a pro rata basis. It's simply the employer will be responsible to pay a contribution based on the earnings that employee has earned in that particular employment, irrespective of what they may be earning elsewhere.
There's another question here. When an employee in the scheme reaches 60, do the contributions continue to be deducted until retirement age? I think this will be between the employee and the CPA. Automatically, I presume that the instruction will be to stop the deductions or stop the contributions, but the employee in this case can continue to opt in after the age of 60 until whenever they decide to retire. That's my understanding of how it's going to operate. And similarly to anybody under the age of 23, they can opt in as well.
Yeah, again, it's not totally clear as to whether the employer then is off the hook, so to speak, from age of 60. The employee can continue to contribute, but whether the employer is legally obliged to contribute is not totally clear.
Yeah. Another thing here, the employee opts out after 6 months. Does employer continue to pay? No, they don't. No. Interestingly, in the opt-out situation, the employee, as far as I know, will receive a refund of their contributions, but the employer won't. It'll remain in the central funds should, I guess, that employee ever decide to enroll again. But if not, it'll just go towards the overall funds available for all employees, as far as I'm aware. So basically, the employer doesn't get any refunds in the case of employer or employee opting out.
There's a question then here, does the employee advise the CPA or the employer if they wish to opt in or out? The employer has absolutely no hand, act or part in auto enrollment other than to do what they are instructed. So if the employee wishes to opt in or opt out, they will need to direct all that through the Central Processing Authority, and then based on that, the Central Processing Authority will issue the instruction to the employer. So it's a bit like in currently with our people with multiple employments with tax, the employee has the ability to decide into which employments they want their tax credits to be applied. The employer has absolutely, again, no hand, act or part in that. They would simply be given an instruction via the RPN as to what the relevant tax credits and cutoff points are, and auto enrolment is intended to work in the same process as that. And
sort of leading on from that, one of the questions here, is there any probation period? No, and I know a lot of company pension schemes, you know, the employee would only qualify for that after completion of probation period. This is nothing like that at all. As Mark said, it's up to the instruction that comes out on the RPN, and the employer is obligated to follow that instruction. So the employer can't opt out of this scheme under any circumstances. It's a bit like paying tax, effectively.
Yeah, and unlike and again, whether this will come out in the wash again, unlike with the statutory sick pay, which has just come in, where the employer can apply to the WRC, the Workplace Relations Commission, for a derogation and actually paying SSP based on the inability to pay. There does not seem to be at the moment anything within the legislation that would suggest that an employer will have that right. It would look as if it'll simply be a legal requirement. End of story.
Another one here is basically can you have auto enrolment and a private pension scheme? And yes, the guidance at present is that the two can operate hand in hand, even though the way their tax relief applies is different. In other words, the auto enrolment doesn't have any tax relief for the employee because the government is topping it up, whereas a private pension scheme, that will continue to be qualified for the normal type of tax relief. It'll be an interesting thing that area I think is going to get quite complex, I'd imagine, and it'll be very interesting to see the guidance that comes on it.
It will be. The other thing just to note is that auto enrolment pension contributions made by the employee are not tax deductible. So in a normal private pension scheme, an employee contribution and an ABC up obviously to certain limits and all the rest are allowable against tax. An auto enrolment pension scheme, there will be no tax allowance, or it is not allowable against tax up front. The quid pro quo on that is that the employer will be making based on when we get to the full 6%, they will be contributing an additional 2% directly to the fund to the employee fund. And there's also a question here: if the employee passes away, what happens to the pension fund? The pension fund is part of the the employee's estate, so it will be treated in the normal way as it would with any other asset or pension scheme, for that matter.
Another question here: does the scheme only come into effect once the employee has reached the 20,000 earnings, or if it's known that their yearly salary will be higher than this, it can be applied since their first week? I think the question here really is that how will the CPA, I guess, know, whether somebody is going to be over the 20,000 lower limit? And in this case, I think it'll just be, they will get that information from the PSOs that are submitted as to that person's periodic earnings. They will make the annual calculation on that basis, and once the PSR figure multiplied by 12 or 52, as the case may be, exceeds the 20,000, that's when the actual instruction will start to actually deduct. I don't think that obviously the employee can opt in prior to that time, or prior to the CPA becoming aware of the higher figure. But I can only see them working it on the basis of what they're told from the PSR, unless the employee themselves want to opt in.
An interesting question here then on long-term sick pay. No contributions required by the employer. Good question. That that probably is something that will need to be teased out. Not completely clear as yet as to what the situation will be in that respect. I don't know, to be perfectly honest with you. It's one of those questions that has been asked, but as yet we've no visibility as to what approach they will be taking in respect to that.
Yeah, I think we've probably covered the bulk of the subject matters in the questions here, Holly. I think we're probably good to go.
I think you've covered the vast majority of them there. A lot of them are repetitive, but yeah, we'll leave it at there. So big thank you to yourself, Paul, and to Mark for joining us for the questions and answers today. And we hope you all found it useful, and we will be sending the follow-up email later on today with the link to the recording and a copy of the presentation slides. So thank you all.
Great, thank you very much.
Thank you. Cheers.